Good evening, everyone. I want to welcome you to our presentation tonight regarding life insurance. We'll start in just a moment to let our guests join in. Okay, looks like we're ready to begin. So good evening again. My name is Chris Malloy. I'm a certified financial planner and senior advisor with TMFD Financial. I'd like to welcome you to our presentation regarding life insurance with our guest speaker, Sanjeev Tidke. This webinar will take a deep dive into life insurance, including various strategies that utilize the tax-exempt nature of these plans, including the tax-sheltered growth of funds, extracting tax-free capital dividends from a corporation, leveraging cash values for business or personal retirement needs, and much more. Our goal is to demonstrate the variety of powerful ways that permanent life insurance can be used effectively. And I'd just like to add from my personal experience, I believe life insurance is underappreciated for the tax and estate benefits that it offers. So hopefully after tonight's presentation, there will be a better understanding and awareness for including life insurance within your own personal financial plan. I'll be introducing our speaker in just a moment, but first, I'd like to hand things over to my colleague, Jake Giesler, who's managing the technology for us tonight, and to provide some housekeeping items.
Thanks, Chris. Hello, everyone. My name is Jake, and I'm also a planner here at TMFD Financial. I just want to run through a few housekeeping items before we get started. So this webinar is scheduled to run to about 8:30 p.m., and there will be a Q&A session at the end of the presentation as well. So if you have any questions for Sanjeev, please ask them through the Q&A section at the bottom button at the bottom of your screen. If you have any questions for me regarding the stream or the technology of this presentation, please reach out using the chat box that's also located at the bottom of your screen. Our next webinars will be taking place with Dr. Murray Arlen on Thursday, April 27th on interesting multidisciplinary case presentations. I will post a link to register for that in the chat box, but just please take note that it is on a Thursday as today is a Wednesday. But that's all I have on my end. So Chris, I'll throw it back to you.
All right, thank you, Jake. Okay, so I'm very pleased and excited to introduce our speaker this evening, Sanjeev Tidke. Sanjeev joined the TMFD team last year as our in-house insurance specialist, but he has been supporting us for many years behind the scenes during his work with Asante Estate and Insurance Services. So Sanjeev brings his technical knowledge and his enthusiasm to develop comprehensive insurance solutions for our clients. All right, Sanjeev, I'll turn things over to you to show us how the various ways that life insurance can be used to our advantage.
Well, thank you so much for your kind introduction, Chris and Jake. Really appreciate this. Good evening, everyone. My name is Sanjeev Tidke. I work as the insurance consultant with TMFD Group, and I work as an insurance advisor with the Asante Estate and Insurance Services. That's the insurance brokerage that we deal with. I've had the pleasure to work with both the teams for over 10 years now. During my tenure at Asante, working and helping TMFD and supporting them with their insurance work. So I'm so glad to join this team. I can't put that in words. I waited for a very, very long time to officially become part of the team. I'll probably say 10 years now. And I'm so happy to be on this side of the business. So with that said, let's get going and see what the presentation is all about. So before I begin and tell you more about insurance and how life insurance can benefit you or your financial circumstances, I just want to take a moment to go over the disclaimer. So this presentation is strictly for educational purposes of our dental professionals. If you're viewing a live version of the webinar, which is today on the 23rd, of March 2023 at about 7 p.m. But if you're viewing a recording version of this on YouTube or any other platform, please note that this is strictly for educational purposes. This does not constitute a legal, tax, financial planning advice. Individual circumstances could vary. You need to contact your relationship manager at TMFD or your own tax, legal, or financial planning advisor. The presentation is not product centric. We are not going into a deep dive of every single product. It's more holistic approach just to understand what products are and services are. Insurance products and services are provided through Asante Estate and Insurance Services. That's the insurance brokerage. TMFD is not related to or associated to Asante Estate and Insurance Services. With that said, a little bit about the parent entity TMFD Financials. I am incredibly proud to be part of this organization. I personally believe that as a dentist, you need a one-stop shop for all of your financial needs. TMFD provides you this. The cornerstone of what we do has got to do with tax and planning. However, tax and planning is not the only thing that we do. We are really proud of the offering over there, but at the same time, the team consists of investment managers, insurance advisors, corporate lawyers, bankers, practice consultants, estate lawyers. So it helps to have one-stop shop for every need. As you may have noticed, as you've gone through the career or your life cycle, you started off as a young dentist, probably joined a practice as an associate, graduated to remain a established associate, to then becoming a practice owner yourself, then on graduating from a practicing dentist to a having a solid practice which has multidisciplinary approach. TMFD helps you with each and every step, and that's the reason why I'm extremely proud to be part of this organization. Yes, there is a bunch of stuff that we are going to talk about, but I have a lot of slides, and I'm going to warn you that these slides are going to get increasingly complex. So if you have any questions, please do post those questions up, and we will take those questions up during the Q&A session. There will be some slides that are basic, and I will run through them. And there are some slides that may require a lot more explaining, and I would spend more time on that. So if you remember last year, we did a webinar that was regarding the living benefits. In the event you have missed that, please visit us at TMFD Financials or tmfd.ca and visit the Academy section where you have a recorded version of this webinar. Today, we are going to focus on life insurance. Having said that, life insurance is not the only insurance. There is also wealth insurance, and then there is also property and casualty, liability, and commercial insurance. Each of these insurance solutions are important for you, and you may want to spend more time understanding each one of them. Today, our focus is life insurance, so we'll get into it and we'll talk about it. Now, on the surface, a lot of us understand why we need life insurance. Many of us are married or couples in relationship, live together. We have two spouses over here. One of the spouses passes away. Now we're thinking about the welfare of the family. How is one spouse going to take care of the children? How do they take care of the basic needs like food, clothing, shelter, education cost, and whatnot? It could sometimes be really challenging if we compound debt into the situation. I mean, in the day and age we live in right now, having a big giant mortgage has simply become a norm. And to service that kind of debt, we need two incomes at a given point of time. And if one of the income is not coming to the house, it can get challenging. There are other issues regarding taxes as well, and we'll touch upon that in a little bit, but just wanted to allude to you the fact that if one spouse passes away, then the other spouse needs insurance. This is on the personal insurance need per se. Having said that, do you really need insurance inside your dental professional corporation? Well, the first thing that I've noticed, and many of our dentists, when they graduate, is that they start off with a student loan. Depending on how long they've studied, where they've studied, it could really be a meaningful number. It's not super significant. It doesn't run into millions of dollars, but it could certainly be in the a couple of $100,000, and we see that it's not out of the ordinary. The second big debt that we see is when associates buy practice and become full-fledged dentists with a dental practice themselves. Almost every lender that we see with their lending agreements mandate the use of life insurance. So first and foremost, If you have debts inside the corporation and the bank has mandated use of insurance, then you probably need life insurance in the corporation itself. Next is the value of practice. Now, I put a chart over here. It's not necessarily a chart, but it's just a print screen from Google Maps. This is the neighborhood in North York that I live in. It's the intersection of Lawrence and Don Mills. What I want to stress upon at this point of time, and as you would notice, is that this block, which is 350-meter wide by 350-meter long, has 10 dental practices. I'm not talking about 3 kilometer and 3 kilometer length and breadth. I'm talking about 350 meters. Within these 10 dental offices that we have in my neighborhood right now, this is where I live. In these dental offices, they house over 20 dentists, not counting the support staff, just purely dentists. The challenge that you have as a practicing dentist is that, okay, we are running a practice, we are running a successful business, everything is great. In an uncertain event that you pass away and you are the only dentist in that practice, and if you are in any of this situation, how hard is it for a client to walk from Dr. King to Dr. Lamb, who are actually right in front of each other, or from Donway Dental over here to Lever Dental, which are exactly the same building, just on different floors, or move from one clinic over here to the other clinic over here. It's actually, if you're standing at the center of this box that I'm pointing to right now, you can literally walk from one end to the other end and come back in less than 5 minutes. That is the competition that you face on a daily basis. Why do I bring it up for you? Well, for many dentists, the value of their practice forms one of the biggest parts of their overall portfolio, of your overall net worth. That actually forms the biggest part. And the value of your practice is based on either the cash flow method or the revenue method. But in each of these methods that we speak about, it is all reliant to a revenue being generated. That revenue gets significantly impacted when a client finds out that, okay, my dentist has passed away, I need to move to the next dentist. So that's the next point that you may want to be careful about. Next is that we see sometimes we have dental practices which have more than one dentist, and both dentists or multiple dentists can own part of a practice. There are times that when one of the dentists has passed away, the other dentist may want to buy out the shares or the ownership of the deceased dentist from their spouses. I mean, at the end of the day, a dentist understands what dental practice is, what challenges are there. The spouse of a dentist who may not have been part of a dental practice may not be aware. It sometimes poses challenges to have people who are not from the same fraternity as part of the business. Now, your big challenge, I understand, is, at the end of the day, is that yes, you want to buy the shares out or you want to buy their portion out. How do you come up with that liquidity? Just because a partner has passed away doesn't mean that the valuations have gone up and the banks would line up to give you more debt to buy that. So that's one of the things why we talk about use of life insurance inside dental professional corporations. It doesn't necessarily have to be permanent insurance. It could be simply term insurance, but it's important. The next item on agenda is that a dental professional corporation is actually a health professional corporation. For it to become a health professional corporation, a dentist in the province of Ontario, now I know we have viewers today who are across the country and are listening across the country. We have members from Alberta, Manitoba, as well as British Columbia today. But I'm just giving you a reference of Ontario, but I believe the situation is pretty similar, that your dental society or your dental college issues the certificate of authorization for a health professional corporation. This certificate has to be renewed every year. In the province of Ontario, this renews on the 31st of August every single year. You have to be in good standing to get your continued authorization from the dental college. The challenge you have is in the event an individual passes away or a dentist passes away, I'm sorry, your licensing body may not issue the certificate. And if it doesn't issue the certificate, now all of a sudden you're in that zone. Okay, I have an operating company. I lose out that status in the event I pass away. How does my spouse get to sell it? So there can be complications over there. And sometimes for protection of the value of the business, it may be important. And at the same time, there are other regular planning needs which exist, which could be in terms of estate equalization when you have more than one child. One of them is in business, the other is not in the business, and you're hoping to sell the practice to your child, but the other child also has to be taken care of. So you're thinking about having some kind of planning mechanism. At the same time, we understand that when you pass away, the biggest tax bill of your life probably maybe at the time when you pass away, and it may help to use some insurance inside corporations, not necessarily an operating company, but with an associate company or other holding company mechanism that we can look into at a later point of time. And I would strongly, strongly suggest you that you probably may want to work with our tax and accounting team. I believe we've got one of the best accounting team in the business, and Steve Fernando is a good friend of mine, does a phenomenal job. So please reach out to our tax and accounting team first up. Okay, so quick overview on insurance. What exactly is life insurance? What am I talking about today? And why is this death benefit tax free? Well, life insurance is basically a financial tool that offsets the impact of premature death. You pass away, it pays a tax free death benefit, and that is what the product is supposed to do. But why is the death benefit tax free? I mean, we all say it's tax free. Why? Well, the answer is pretty simple, and you have to go back a little bit in history. So back in 1917, when the world was at wars, and we're talking about the First World War, back in that time, Canada was going through a recession, but at the same time, we were pushed into a war. So we are like, okay, we need to come up with resources, and how do we fight this, and how do we come up with resources? So in 1917 was the first time when direct income taxes were actually imposed in Canada. And the act enacted at that point of time was called the Income War Tax Act of 1917. At that point of time, the politicians who put the bill together thought about, life insurance. It's a widows and orphan benefit. Probably is not going to sound very well, or probably it's not going to go very good if we start taxing widows and orphan benefit. And from that date till date, we've had changes to the tax act, the type of income, the amount of taxes, and things like that have changed. Numbers have gone up, but uh, but life insurance has generally been kept out of the tax act as far as taxation of the death benefit. So I'm so very happy that it has been a tax-free benefit for a very, very long time. The next thing that comes to mind is, okay, cash surrender value for UL and whole life, and its growth and tax exempt. Why are these tax exempt? Why do we talk about this cash surrender value? Well, here's how it works. So cash surrender value, in theory, is actually a policy reserve. It is supposed to back a future death benefit that is supposed to be paid. So the money which is there in the policy at a given point of time is what is required to grow enough so that a future death benefit is to be paid. So on the technical side, when the insurance companies look at the calculations that they have to mandatorily follow to keep a policy exempt from taxation, the policy is a 8-pay endowment to age 90. So the insurance company at any given point of time has to measure what values exist in your policy and measure it with this theoretical policy that I just said. And at any point of time, the values of your policy exceeds these exempt lines, the policy can become taxable. The insurers make all attempt to keep the policies tax exempt, and that is the reason why the money in the policy keeps growing over a long span of time, because it has to be set aside for paying a future death benefit. Certain policies have living benefits. Now, it's really interesting. We are talking about life insurance, and here I am talking to you about living benefit. Makes no sense, right? Well, in true sense of word, there are policies which include whole life policies and universal life insurance policies that actually provide for that in the event you get disabled and you're not able to do your job, or you're terminally ill, or you are in a state of long-term care where you're unable to do two activities of daily living, or you suffer from cognitive impairment, or you suffer from Alzheimer's, or you suffer from dementia, you are able to pull out the account value of a universal life insurance. And in case of a whole life, you're able to pull out the cash value of the paid up additions. Now, please bear in mind, not all insurance companies have the exact same wordings in the contract. So you have to be mindful of which insurance company, what product you buy to achieve that kind of purpose. Personally owned policies. Now, there are two phenomenal aspects of a personally owned life insurance. First is that it has a named beneficiary. And because it has a named beneficiary, it bypasses probate and goes straight to the named beneficiary. Um, I hear this many times when we speak with state executors, that it usually takes time for the estate to settle, for any monies to be paid out. Now, you could only imagine that once a person has passed away, and I'm talking about the second death of husband and wife, now all the financial accounts are frozen. The executor of the state has to run from pillars to posts to ensure that all of the assets are pulled into the estate and there is money, so that money can be paid to different services that is being empowered, that have been provided to them at that point of time. Sometimes it takes up to 3 years and the executor could be out of pocket for these expenses. So that's a good reason why personally owned life insurance can certainly help, because it just bypasses the probate. The beneficiaries get, sometimes we see that the beneficiaries of the insurance contracts in some shape or form are also the beneficiaries of the estate. Sometimes they lend money to the executor, or sometimes they themselves are the executors. So it really helps. The other part is for business owners. So if you're a business owner and you're looking for ways on creditor protection, then insurance could be an option. However, there has to be this has to be very carefully looked into. Firstly, any policy, any product that you seek, if you are seeking solely for the purpose of creditor protection, you may not necessarily get that, because at the end of the day, you have to buy something for the right reason. The right reason is that I bought insurance contract for myself. Should I pass away, I want my wife and my kids to be taken care of, or maybe there is a charity that I support, or maybe my nieces and nephews that I want to help. So there is some kind of right intent that I have to have in my heart. In case of creditor protection, two things have to be matched. Number one, you can't necessarily seek a product only for a specific aspect, that you wanted to get creditor protection because you had creditors. That probably would not fly. Number two is that your beneficiaries have to be of a preferred class. So preferred class beneficiaries include your children and your spouse. Those two things have to be matched. On a corporate basis, life insurance can actually go to the next level. Why? Well, first thing is that when you compare the cost of paying a premium inside a corporation versus the cost of paying premium at a personal level, generally it's more costly to pay premiums from personal hand. That's because your corporation has to pay you the money to pay the premium, plus the tax on top of the money to come up with the money to pay the premium. Versus inside a corporation, yes, the corporation has to make an income, but corporations typically, at least if you're a small business a small business corporation or a small business tax rate applies to you, then the corporation could be at a 12% tax bracket versus you could be at a 45% tax bracket, even higher depending on where your income is. So it could be tax advantageous or cash flow advantageous to pay it out of corporation. Number two, part of this benefit is what my friend Steve Fernando talks about, the hidden gem. The hidden gem inside a corporation, which is the capital dividend account, which allows to pull or extract tax-free capital dividends from a corporation. So life insurance actually qualifies for that. The proceeds of insurance that come to the corporation come tax-free. The amount of money that can come out of the corporation as a tax-free capital dividend is equal to the death benefit minus the cost base of the policy. So you can certainly imagine that you're paying from a lower tax dollar and the money is coming out on a tax-free basis. It's kind of a win-win on both sides, which generally you would not see on many other aspects. So that brings us to a question. What type of insurance? Oh, what kind of insurance is ideal choice to cover mortgage? Well, uh, is it term insurance? Is it car insurance? Is it Galaxy Life insurance or is it professional liability insurance? I'm not 100% sure if the question came in on the right slide, and I apologize, but I certainly see that a lot of you have been answering this question on the right path, because I don't necessarily know much about Galaxy Life. So if you've got the answer, well, almost 92% of the participants have answered term life insurance. That's an excellent answer. Thank you so much for the answer. All right. Not all insurance contracts are the same and have the same attributes. Now, as much as I want to talk about tax sheltered growth and tax-free benefit and that we're able to leverage the cash values, not every single product comes with that option. I'm going to give a quick overview of term insurance. I believe majority of you are aware about this product, but we typically get a term insurance for short-term and medium-term liabilities. The premiums of this product typically come fixed for the duration you buy. So if you bought a 10-year term, it's fixed for 10 years. If you bought a 20-year, then it's fixed for 20 years. And then at time of renewal, the premiums go up. Now, the newer generation of products come with a YRT. So back in the day, if a term 10 renewed, the premium would go up 10 times. Now, the newer generation of products have come out where the premiums go up by 1 time, 2 times, and then every year those premiums go up. So it kind of helps at the end of the day with this kind of product. Okay, depending on individual circumstances, like, as much as I would want to say, hey, it's for short-term needs, we want to do it for buy-sell purposes, we want to do it for business value protection, there may be times that you may need this for a much longer duration. It just depends on your individual circumstances, and we're happy to help you. Please give us a call, and we'll be happy to walk you through this. In terms of permanent insurance, I'm not going to spend too much time on these two types of permanent insurance, which basically is a term to age 100, where you have a fixed premium for the rest of your life and a fixed death benefit for the rest of your life. It's a good product at the end of the day because it provides the least cost option. The biggest challenge with this product is that you miss a payment, you get 30 days to make up the payment and keep the policy going. If you're not able to make up the payment, then the policy would lapse. So when I think about this product for myself and I'm at age 44, I wonder that, okay, I would have this product probably for the next 56 years. If I live to age 100, I probably would have at least 670 plus payments. What are the chances my address doesn't change, my bank doesn't change, I'm sick, I'm old, I'm not able to answer? All it takes is one missed payment. So that's the reason we seldom talk about this product to our client, because we believe that it may be the lowest cost option today, but it may hurt you in the long run. The next product on the agenda is a non-par whole life. It's actually a one-up version of a term to age 100. Again, permanent, fixed death benefit, but what it does have in it is cash values. So at the end of 10 years, 20 years, something has happened, you're unable to pay the premium, it goes on a policy loan. Sure, your death benefit was $1 million, you didn't pay the premium, there's a loan of 20,000. Okay, no problem. There's a loan of 20,000, but at least 980,000 were saved. So that's kind of where the benefit is with a non-participating whole life. Term to age 100, non-par whole life. Don't forget, there are two types of permanent insurance. The one that pays a death benefit regardless when you pass away. The challenge with either of them is that their death benefits does not grow. Okay, growing death benefits. We have two separate kinds here. There is a universal life. I know I'm talking about universal over here. Hey, it is a universal life insurance and a participating whole life policy. Two of the best products which are really critical as far as estate planning is concerned. And you'll see some of the features of these products on how they can help. It universal life has kind of lost a lot of its appeal, and I will go into it in the subsequent section. Participating whole life is a lot more used these days, and there are reasons why it's more appealing. Not that there is anything wrong with universal life insurance product. This is one of the best permanent insurance product that was ever created. It's just that unfortunately, there have been rule changes as far as the amount of money that can go in a universal life insurance and how much of it can remain tax sheltered. So it's kind of lost its appeal as of 1st of Jan 2020, 2017, when the new rules came in and the ACB and the entire lines change of the product. But in the essence, the product is solid. What it does and what it has is an investment account with it and life insurance to it. So when you pay your premiums into this contract, it goes to this investment account. Now, before the money is actually invested, the province, which depending on the province that you live in, will take a provincial premium tax out of the premiums deposited. That is just how provincial premium tax works. But they take the premium tax out, the balance of the money is now in the investment account. From the investment account, the first thing that has to be serviced is right here, the cost of life insurance. But the balance that is remaining is invested, and it's invested depending on your KYC, that is based on your risk tolerance. There's a wide variety of investment options available. Typically, clients who like to do it, investments choices based on their needs and like to change it from time to time, like to go with a universal life insurance because they have much more control. The biggest drawback of a universal life insurance on the same aspect is that because the investments are invested into the different investment options and the values of those investment options can change daily, you may see volatility of the investment inside. Now, when we buy insurance, we are kind of defensive already. We are trying to be thinking that, okay, if things go south, so probably a risk tolerance is not high over there, but doesn't mean everybody is like that. We have clients who've actually utilized universal life insurance, paying a single premium for a policy and having those policies paid up. Unfortunately, those policies are now not available, but it still remains a cornerstone when it comes to the lowest cost permanent policy or the lowest cost 10-pay product, or in the event we want to extract the most CDA out of the corporation. So where your need and desire is not necessarily tax sheltered growth, you're looking and extracting most money out of the corporation as a CDA credit, this may be a choice of product. A whole life. Oh my God. Uh, Question time. There is a question, so I better pay attention on this. Okay, so participating whole life is the fourth type of permanent insurance. We've covered a T100, we've covered a non-par whole life, we've covered a universal life insurance, and this is a participating whole life. Here you have growing death benefit, and we will get into the mechanics of how this product works. But the biggest thing for this product is that it is eligible for dividends. Those dividends can increase the value of the policy, that is, increase the cash of the policy and increase the death benefit of the policy. And I'll get into a little more details about this policy in a little bit. But first, we have a question. So, which of the below are permanent life insurance? So we're talking about permanent life insurance, right? Is whole life a permanent life insurance? Is universal life insurance permanent life? Or is term to age 100 T100 permanent life? Or the one and only D, all of the above? All right, we are getting the answers, and why a big majority of you have said the right answer. It's all of the above. Whole life universal life, and term to age 100, all of them are permanent insurance. So thank you for paying attention over here. All right. So participating whole life. Now, to understand participating whole life insurance, you just need to go a little back in the history and understand how exactly this thing came about. Well, back in the day, majority of insurance companies were mutual companies. They were not owned by shareholders over here. They were owned by participating policyholders. So you've bought a participating policy from us, you became a owner of the insurance company. And then anytime an insurance company made a profit, and which is basically at the end of the year, when they look at the books and they're like, hey, we made profit. Okay, well, a share of that profit has to be paid to these policyholders over here. Now, policyholders held a policy with them. So what they did was they paid the policy dividend directly to the policy, which increased the death benefit of the policy and increased the cash of the policy. This is how participating whole life policies came into existence. Now, going fast forward in future, in the 80s, majority of Canadian insurance companies were thinking, well, we probably want to globalize. We want to go out there, capture the markets, want to do some good. Okay, awesome. We need a lot of money. Where do we get this money from? How about we get publicly traded? How about we get listed in the stock exchange and we raise money from the share market? Okay, that's a good idea, but we still have these policy holders and we want to still sell insurance. No problem. So the concept they came up at that time was that, okay, we'll create an open block. Okay, this open block is for these participating policies for our new policy holders. With this open block, we are going to work it exactly how we were working while we were a mutual company. Okay. And the risk of running the business is now being shared by the policyholder over here. And you may be with the question, okay, what risk are we talking about? I will get into it in a bit. Okay. So those policies got associated with this open block, and that is the block where policies are currently being sold out of right now. There is a participating account. This is the account that basically services all of the open block policies. Now, you may have with an insurance company separate open blocks and separate participating accounts associated with different open blocks at a given point of time. Insurance companies have also merged, amalgamated. So, for example, Canada Life, Great West Life, London Life, all merged, became one giant company. Canada Life is the largest insurance company in Canada, and they also have the largest participating account, which is upwards of $44 billion for that matter. So they did consolidate some of the stuff. Some of the stuff is still open. So how does this participating account and this policy works? So in the essence, when an individual buys a participating whole life, they are participating in the risk of the insurance company. But that risk is subjected to the risk of the participating account that they're dealing with. It's not the general risk of the insurance company. It's not the worldwide insurance risk of the company, and it's not the worldwide exposure. It's the participating account that you're looking at. So when you're talking about the participating account, what account am I talking about? Well, look, when we have a block of policies, those block of policies have premiums that come in. So premiums come into this account. Okay, makes sense. Well, we have general expenses to run the business, but you can't really attribute the entire business's expense just to one participating policy account or a par account. So they get attributed according to their sizes. Okay, they've got their expenses narrowed down now. Fine. Death benefits that are paid to the beneficiaries of the policy are also paid from this participating account. But it can't be the death benefit of term insurance that was sold or universal life insurance that was sold. It is death benefit of participating policies that are participating in this block over here. After paying the death benefits, and if clients surrender their policy, then cash values are paid out of here. Now, what the insurance companies do is from this account is where they pay the policy dividends. And I'll speak to policy dividends in a bit. If at the end of a year, the insurance company is in a favorable situation, then a dividend could be payable. Now, how would they be in a favorable situation, and how does this come about? Well, here's how it works. So at the beginning of each year, an insurance company makes a benchmark assumptions on mortality, their expenses, their rate of return, their policy lapses. All of these different things are taken as benchmark assumptions, and they put weightage on each one of them. Now, majority of these items have been pretty stable. Like, they understand what the expenses are, they understand what their mortality costs are, they understand what their other expenses are, but what they don't know is what their investment return is going to be. That typically constitutes the biggest portion of the overall risk of this account. So for that reason, they measure this at the end of the year and say, okay, we've thought that we will have this performance over here, and we are at this performance at this point of time. If the actual experience is better than the assumption, then they are in a favorable situation and thus be able to release funds or dividends to their policyholders. Now, typically, the asset allocation of an insurance company is fairly conservative. They are not shooting for highest growth or highest gains. What they're shooting for is stable, long-term returns, capital preservation. That is paramount to them. They need liquidity because they have to pay that benefit. At the end of the day, the insurance company is on a legal contract and has an obligation to pay a death benefit. So because they have to pay a death benefit, they cannot really go crazy, invest everything into equity. Now, because each insurance company is different and their mandates are different, it'll be hard for me to pinpoint and say, okay, here is 60% bond, 40% of equity, and rest 20%. They're all scattered across the board, but generally you will see a heavier weightage on the government bonds and private bonds. There is private placements to commercial real estate. Typically, you would see that as a big component. The other component that you would generally see is that they do have mortgages in there. So mortgages do share a big portion of the overall portfolio. There is equity, but equity generally is based on the broad indices that they follow. So if they're following S&P TSX, they probably are looking at the TSX 60 or maybe TSX 500. The weightage on equity is generally lower. So max I've heard and seen is about 20%. The lowest could vary. It is depends on the approach of an insurance company, and they may vary all over the space on this. Now, policyholder dividends and shareholder dividends. Sorry about that. So when it comes to a participating policy, we understand that companies like Sun Life, Manulife, Canada Life, in some shape or form are publicly traded company. They're listed on the stock exchange. And as a policy holder, I'm worried that, okay, well, this participating account makes some money. How am I how is my interest being protected, that Sun Life is, or Manulife, or whichever life? I'm not picking up any insurance company for that matter, but I'm just raising a concern that how does a policyholder get protected? Well, there are certain acts in place that protect policyholders for that matter. Anytime an insurance company from its participating account releases a dividend, of that dividend, between 2.5 to 10% of the dividend can actually go to the shareholders, and the balance can go to the policyholders. So if a dollar of dividends is being produced, of the dollar, from 90 cents on a dollar to about 97.5 cents on a dollar goes to the policyholders, and about 2.5 cents to about 10 cents go to the shareholder. Bigger insurance companies who have got larger power blocks are required to keep this low. There is a certain threshold that has to be matched. Once that is matched, then the number is between 2.5 to 3%. So for Sun Life, Manulife, Canada Life, typically that number ranges from 2.5 to 2.89%. And it is also the reason why we promote these companies slightly more than the smaller insurance companies at the end of the day, because we believe that they have a bigger obligation to service their policyholders as opposed to a few others. I'm not saying any other insurance company is bad, or they're not doing a good job, or they're pumping out too much dividends to their shareholders. None of that. I'm just mentioning this because these are records that we have. Okay, now in terms of the rate of returns and how the returns could impact, what the insurance companies do is that they take this approach of smoothing. Under smoothing, here's how in a layman language would work. That if you have a rate of return in a given year and you had a spectacular rate of return, let's say you had a great year of about 20%, the insurer does not credit the entire 20% towards the account altogether. Because what they do is that they take a big portion of that gain to normalize a future loss. Or if they've had a big loss in a given year, then they take some of the uh, past gains and normalize that. That really helps, because if you look at the dividend scales for many insurance companies, and as an example, I'll talk to you about Sun Life, because back in the day in 2010 and 2011, I was helping few clients with participating whole life policies. Their dividend interest scale at that given time was about 7.5%. Today, after the announcement that came out about dividend rate for this year, on the 1st of April, it goes to 6.25. So from 2012 to right now, in 11 years, it has gone down by about 125 basis point for that matter. So in grants and from between these past 12 years, it has gone down by 25 basis point or remain the same, gone down by 25 basis point or remain the same. But what I want to point to you is over this long span of time, the fluctuation that has happened has been relatively very small as compared to the overall fluctuations that you may typically see on an indices at a given point of time. The other big factor when we talk about a participating whole life policy is the concept of vesting. What is vesting? So I spoke to you about this concept that you will get dividends, and dividends will come inside the policy and they will increase the value. Once a policy dividend is given to a policy, that value gets locked. So in the subsequent year, your policy values could be higher or equal to what you had last year, but it cannot be lower than what you had. So when I go back and say, hey, I had this universal life insurance, well, the values could change on a daily basis. But with the whole life, it's a lot more stable because money has gone in, a dividend has been paid, and now that dividend has bought, paid up additions and increased the cash value, so it remains fixed and locked at that time. Q&A time. So yes and no. So it's a simple yes and no question. ABC Life has issued policy dividends to its participating policyholders in 2019, but they have suffered massive losses in 2020 due to COVID. Some analysts are suggesting that ABC Life may recall policy dividends and give it back to the shareholders. I don't know about that. Can ABC Life recall policy dividends and distribute the policy holder dividends to their shareholders? Yes or no? All right, we see some questions, we see some answers coming in. That's awesome. Give it a few seconds. Yes and no. Oh my God. There's actually a pretty big portion of attendees that actually believe that this can be done. Well, in reality, once a policy dividend has been paid to the policy holders, that dividend is irreversible. It remains vested within the contract. It does not go back to the insurance company. The insurance company cannot recall dividend. In a subsequent year, the worst case scenario that they have or they could do is not pay a dividend, but they cannot pay it back. Now, when I say insurance company will not pay dividend, that is actually a worst case scenario for a participating whole life. And then looking at the participating whole life policies sold by Sun Life, Manulife, Canada Life, and ever since these companies have been selling these participating whole life of recorded histories, and what they've provided us to in written is that they have paid dividends to their policyholders every single year, despite the First World War, the Second World War, the Great Recession, the Vietnam War, the oil embargo, 2008 financial crisis, COVID. Every single time a dividend has been paid out. So please be rest assured that these policies are taken care of, and the insurance companies do pay policy dividends. All right. So with that said, I think we're going to get into what is beyond death benefit. And I think I've spent the majority of portion talking about just life insurance. I haven't even touched the subject on this. So I will be going a little fast, but I will talk about the important topic over here. Okay, tax sheltered growth. So we are considering a case of Dr. John and Dr. Jane Smith. Both are practicing dentists. They own a dental professional corporation and have an associate corporation for planning purposes. They have established practice, and they're thinking about, okay, do we have another option where we can tax shelter our money? We are incorporated, we have set up associate corps, we have maximized our TFSAs, we've maximized the IPP option. Is there something else that we could look at? And it's just an option that they're considering, not necessarily that it applies to them. Okay, so their advisor, which by the way, on the insurance side is me, and I'm proposing to them an option. And what I'm trying to do is that I'm trying to compare on the top an investment option, which is basically I will buy you a GIC every single year. You will deposit $50,000 each year for the next 20 years. So over the span of next 20 years, you would have deposited $1 million with me, and every year I'm getting you a 5% GIC, and I'm guaranteeing you that that GIC is going to yield 5% for next 43 years. That is the commitment that you have. No volatility, fixed guarantees. You have some retained earnings inside the corporation. This is an option that I have for you. Nothing changes. But at the same time, I'm also giving you another option. I have a whole life policy where you're going to deposit the same amount of money that you're depositing in the investment. On the insurance side, we call it premium. So you're going to deposit 20 premiums each year, $50,000 over next 20 years. Okay. So one of the questions that keeps coming up all the time is that, well, with my investment is liquid. I can withdraw money anytime I want. I can pledge it against a collateral. Can I do something similar with insurance? Well, absolutely. Yes, you can. You can leverage values of an insurance contract at a given point of time, depending on how you want to leverage those. That could be achieved. If you have no desire to continue the insurance policy altogether and you want to cancel and you just want your money out, you could do that too. We would not suggest to go that route of putting money into an insurance contract and only to surrender it. That's not the right approach at the end of the day for us. But if you wanted to, you could do that. But what is the significant benefit of the insurance contract? Well, if you're talking about money which is sitting inside a corporation, you know that if you were to pull that money out from that corporation, you end up paying taxes on it. So yes, you can tax shelter some of your money inside the corporation or defer the taxes on it, but you cannot eliminate the taxes. We have planning opportunities available, and my friend Steve Fernando does a phenomenal job as far as planning is concerned. And if you've not got in touch with our planning team on the tax planning side, I will strongly urge you to please get in touch with our accounting and tax team. But at the end of the day, if I come back to the scenario and I'm trying to compare, okay, fine, you know what, we did our investment, we put that 50,000 each year. What is that we're getting out of it? Okay, so I'm saying, okay, well, you both passed away, because I'm talking about a life insurance contract. So you've passed away. What is the value that is produced by the regular investment? Well, I see, sorry, it's a little small over here. I'm just struggling with my glasses over here, but I see $1.8 million of after tax money that goes to your estate, and there are taxes that are payable. And I'm sorry, I apologize again because I can barely read the numbers properly over here, but I believe it's about 1.24. On the life insurance side, we see that a life insurance death benefit comes in tax free to the corporation. It goes out of the corporation as a capital dividend, again, which is tax free. So when we are looking at the magnitude of the number, I believe this number is pretty close to $6 million. So you may be like, okay, well, yeah, we got $4 million extra, big deal. Yeah, life insurance sounds good. But uh, with the investment, I had access to it at any given point of time. So I'm like, okay, no problem. Let's see how the investment compares on the cash value with the life insurance. So here on this chart, you're seeing three lines. The blue line over here is the cash surrender value of a whole life policy. The yellow line that you're seeing right at the center is your 5% investment. And the gray line at the bottom over here is the cumulative deposit. So you're depositing 50,000 each year. At the end of 20 years, you've ended up with about $1 million. Okay. So how long does it take for the insurance policy's cash value to be equal to what you have deposited? In this scenario that we are talking about, it takes about 5 years. And how long does it take for the cash values of the whole life to be equal to or greater than the investment option of that 5% GIC? Well, the answer is it is about year 10 or 11. And I'm sorry, again, I'm struggling with my glasses over here. The screen's kind of tiny, but I believe it's between 10 and 11 is when that happens. Next is we are trying to compare, okay, it's insurance. So at the end of the day, I will talk about death benefit. But when I talk about death benefit, I'm trying to talk about the eventual estate benefit. It's the CDA credit that I'm trying to talk about. So how much more am I getting? Of course, I mean, it's insurance. We started off with 800,000 right off the gate. With the investment, it's going to take time to build up and grow and whatnot. So yeah, I get it. But yeah, the all important question is that if I were to assume, 30, 40 years out in the future and say, okay, I see you've paid out a big giant number of $6 million. How much my investment would have had to earn each year if I said, don't worry about this insurance. I don't like this guy, talks too much. Let's find an investment that will actually do the job. Then you have to find me an investment that will yield 11.8% rate of return, which is on an interest basis. So you're finding a GIC, which guarantees that for next 43 years. That is the magnitude that of rate of return that has to be produced by a comparable number. So you are thinking that probably I'll get a better investment outside. Well, that better investment has to be about 11.8. I'm not saying that such an investment option cannot be available or may not be available. I'm just saying I don't know if such an investment exists that will provide you guarantees, pays you in Canadian dollar, is a Canadian investment, and pays you 11.8%. Now, let's quickly look into the mechanics because we're coming to an hour now, so I better hurry up. But let's look at the mechanics of how tax-free money comes out of corporation with use of life insurance. So, simple situation. We have Dr. Jane Doe, who's a dentist. He's 50 years old. He owns a dental professional corporation. He's worried about his family. Okay, if I pass away, my family relies on me. And on top of that, my spouse is the office manager of my dental practice. Now, in absence, if I pass away, how does my corporation exist? How do we go about different things? And we have mortgage and we have other needs in the family. We need to support them, right? So how do we go about and how does insurance work over here? Now, this particular slide over here is not talking any product. It's a generic concept. Sorry. It's a generic concept on the mechanics of how life insurance inside a corporation would work and how money could flow out of the corporation. It doesn't matter whether you have a T100 or you have a term 10 insurance or you have a whole life policy, they all at the end of the day produce a tax-free death benefit. They come with a credit to the CDA, and depending on what their cost base is, there is an amount that can come out of the corporation. So In this case, Dr. John Doe decided that I'm going to buy an insurance contract. I probably would want to have my corporation own it. I'm the insured. Now, the all important thing is that the corporation is the owner, it is the payer, and it has to be the beneficiary. This is the right order in which you have to set the ownership, beneficiary, payer to keep everything in lines with the requirements of the tax guys. You don't want to be offside over there or name your spouse as the beneficiary and the corporation is paying for it and you're the owner. It just makes it a giant mess, because at the end of the day, what you don't want is a taxable shareholder benefit. You just want to keep it clean, and this is the right way to do it. Okay, so in this presentation, if at all there is a bank involved, and if at all there is a assignment on the policy, sometimes there is, and there is a next slide that I talk about in which there is, but in this case, there is no bank or no assignment on the policy. So we see that Dr. John Doe has passed away. I'm sorry about that. And unfortunately, he would pass away more than once in this presentation and he'll get reincarnated again. So sorry, Dr. John Doe. Now we have tax-free proceeds that have come from the policy and have gone to the corporation. For the corporation, there is a hidden gem. My friend Steve talks about this all the time. The hidden gem, the capital dividend account. It's a notional account which is used to track certain tax-free events inside a corporation and is able to pay out tax-free capital dividends. Life insurance is one of them. There are more and other things that are eligible, and probably you would benefit by talking to our teams because they may help you spot some of those for your corporation as well. So the policy is now paid a tax-free death benefit to the corporation. The surviving shareholder, who's the spouse, Jane Doe, is waiting for the money. How it may work in this point of time is that the death benefit minus the cost base of the policy came out as a tax-free capital dividend. Simple, straightforward. There's nothing fancy about it. This is the standard mechanism. Now, there are times where we have spouses and we have debts in the corporation as well as we have personal debts. Okay. And then we have clients sometimes who are like, okay, I'm buying a practice. My bank has mandated a loan. We have to get an insurance policy and we only get that $1 million that they've asked for. I do not want to buy any more insurance. I just want to keep it to $1 million. Okay. $1 million. Fine. Here's what the problem happens when we buy just that $1 million for the bank. So in the event you pass away, that tax-free money has now come from the policy, but before it can go to the corporation, because the policy is assigned, the insurance company pays money direct to the bank first. The bank has the first title on the insurance contract. They receive the money first. The corporation then receives the balance of the money. So you don't receive the full death benefit, neither does the full benefit come to you. But what does come to you is the full CDA credit. And this has been tested with CRA more than once, that because banks and insurance companies work this way, it is deemed that the corporation should have ideally got it. And because we should have got it, we should have received the full credit, and for which CRA has agreed on more than once. It has been raised in the KELU chapters as well. And for that reason, the corporation gets the full CDA credit from the life insurance. Now, if you have a new practice, do not have much of retained earnings, you just ended up paying the bank all the debt, how do you pull more money out than what remains in the corporation? I don't know. I don't have an answer to that. So I would typically say that if you're new and you're starting out, please do not buy insurance for protecting the lender. At the end of the day, your priority and your focus is your family. The bank is concerned about their money, which is true because they are obligated to their shareholders, but you are obligated to your family. So you probably may want to up your insurance amount to ensure that the value that you pay to buy the practice is paid to your spouse. Why, if I may ask again? Well, at the end of the day, when you start out new and you have a brand new practice, you don't necessarily have the goodwill that the clientele will continue coming to the practice even in the event you passed away. If I go back to my neighborhood scenario where I have 10 dentists in a region of 350 by 350, it is not that much effort to move from one clinic to the other clinic. So just a food for thought, maybe. But if it's another example, you have an established practice and you have retained earnings, then guess what? You can use some of the retained earnings and some of the proceeds of the insurance and still kick out that entire amount of tax-free capital dividends. So there is an option that's available to you. Okay, now we do see this often that we have more than one dentist who collaborates together to have a big practice. So we have two dentists over here, Dr. Jane Fonda and Dr. John Doe, who jointly own a operating dental professional corporation. And the spouses of neither of dentists are shareholders of the corporation. And you may recollect in my slide too, I was talking about it that, well, if I pass away, I'm the insurance guy and my spouse is a project manager. I don't think she wants to do anything with insurance, and I have no desire to talk about project management. I don't need to change the word. I'm just happy doing what I do. So if such a scenario happened with us, I probably believe my business partner would probably say, hey, you know what? I don't want to deal with the project manager. So I believe a similar situation may arise when we are working with dentists. For that matter, that non-dentist spouses may not understand the intricacies and the challenges of a dental practice, and you probably may be in a better situation to buy them out at the end of the day because you are running a practice, you have 50 other things going at the same time, and you're worried about increasing your business. And at the end of the year, you want to reinvest money in the business, but the spouse is like, well, I need to get paid. You can do all your investment and increase whatever, but I gotta get paid. I'm not paid. So you may have some challenges. Now, how does life insurance solve that? So we have two shareholders, one operating company. We get two insurance contracts. Again, it doesn't matter what type of life insurance you get, whether it's term, T100, whole life, universal life, it doesn't matter. It's just a concept that we are talking about. The corporation, again, owner, payer, beneficiary of the policy. The shareholders are the insured. In the event one of the shareholders have passed away, now tax-free proceeds have moved from the policy into the corporation. We do have a credit to the capital dividend account. But this is where the value of tax advice comes to play. And why I say that is that there are more than one way to purchase shares or ownership from the surviving shareholder. It could be done on a share purchase with a promissory note. It could be done on a share redemption. It could be done on a combination of the above. The best person to talk on this is probably your tax accountant. And I don't say this lightly, I really mean it, because at the end of the day, purchase of shares or purchase of goodwill works totally different. An accountant is in a better position. And I'm not talking about a bookkeeping accountant. A tax accountant is a totally different individual. A bookkeeper will basically do your bookkeeping, but a tax accountant is the person who is able to find out tax strategies and help you plan better. We are proud in doing what we do, and that is the reason why I emphasize on it so many times in this presentation. So you do have options, and I would suggest that you speak with your tax professional on this. Leveraging cash values. Now, this is important. Many of you have purchased life insurance in the past. Some of you have thought about leveraging policy. How on earth do we go about doing it? There are many different ways to generate cash from the policy. There's not just one way. There's actually more than 5 ways to generate it. And this, what I'm showing you right now, is just the tip of the iceberg. It doesn't necessarily go deep into each one. But one of the simplest one is that you have a lender, and these are specialized lenders. These are not your regular banks. You can't just walk into a regular branch and talk to a teller or the advisor in that branch and they know about it. No. Collateral assignments on an insurance contract or Lending against insurance contract is a specialized line of business. This is not the same business. So there are special teams that are available. Manu Bank, as an example, is one of the lenders that we use for leveraging life insurance, and we found them to be really very satisfactory as far as our overall interaction with them and client services is concerned. So you can assign a policy to the bank and you can get loan from a bank. There's another way, and I've put Canada Life over here to indicate an insurer. Doesn't mean that everybody has to go to Canada Life and say, okay, Canada Life, give me a policy loan. But if you own a universal life insurance or a whole life insurance which has cash value, you can request a policy loan from the insurance company itself. You have to be careful because there are tax implications when it comes to taking a loan from your insurance contract directly from the insurance company. There are certain thresholds that have to be kept in mind, and it can be extremely punitive if the loan value becomes taxable in a year and you do not pay back the entire value in the exact same year. Then in the subsequent year, there is no offset that is available to offset the tax implication of the previous year. So please work with your financial advisor or your insurance advisor before you explore this path. It is one of the easiest path to get loans. For example, some insurance companies require you just to call them. That is all they need, just a phone call that is needed to get a loan. It is that easy, but it can be challenging. It has to be structured properly. So please be mindful. The third and the least commonly talked about is dividends as cash. So you may recollect I was talking about these participating policies, and we're going to give you dividends, and the policy grows over time because those dividends buy more death benefit and increase the cash value. Yes, it can do that. But you as the policy holder, if you own one, that is, you have a contractual right to ask that those dividends be paid to you as cash. They do not necessarily have to buy more paid up additions. You do not have to leverage the policy anywhere. You could be in any financial situation and you could still ask for it, and the insurance company has to honor it because they have it as a contractual option on the contract. So if you trigger that, you can get policy dividends. They come to you as cash. So if they come to you as cash, I mean, are they taxable, tax free? Well, the dividends, to the extent of the adjusted cost base of the policy, come to you as a tax free benefit. The moment the dividends cross the ACB line, then every dollar of policy dividend is treated as interest income. You get a T5 and it's an interest income. It's not capital gain. Neither it is treated as a shareholder dividend. So it's just a notional word of dividend, but the tax treatment is, is as if you had received interest income. That's how it gets treated. And the fourth one, not the favorite, I would not suggest you to buy an insurance contract to surrender it and get the cash out. Please, it is, you are better off not buying an insurance contract and not paying your money than to buy something only to cancel it at a later point of time. It doesn't work that way. We over here at TMFD, we are extremely proud at what we do, and we don't peddle insurance policies. When we work on insurance, there are at least 3 layers that we have to go through to even suggest insurance to you. One is our own internal guidelines that prevents us from talking about certain strategies. So in principle, we don't talk about those cutting over the edge strategies like immediate financing arrangement to begin with. We just are in principle in disagreement with some of those. Number two is that I have to go through your financial advisor first, who looks at it and says like, yeah, the strategy is good, but they are too early in their practice. Then number three, I have to go through the tax planning guys who at the end of the day look at the strategy and say, yeah, it checks all those boxes, but their structure is not right. They only have a dental professional corporation, but they need to have so many other things before these things can be done. So to give you a perspective of why I'm trying to stress so much is that Your best interest is kept at heart over here, and at multiple points people look at it. So we're really proud at what we do, and I would strongly suggest and advise, please, if you are thinking about buying a policy only to cancel it, do not buy life insurance. It makes no sense. Of course, there are tax implications too over here, because if you surrender a policy and the cash value of the policy is greater than the adjusted cost base, it is treated as taxable income again. You're going to get a T5. So steer away. Now, here are quick examples on how we can leverage a cash value of a policy. And quick, simple example is that you're running a practice, you're renting the location, you like the building, and you're thinking, okay, it may be a good investment. Or your landlord is selling you, hey, I need to sell the building. Do you want to buy or want to go? I don't want to renew my lease. Or your landlord has passed away, his estate now is at a point where it's like, hey, we have to pay taxes. So um, how do we pay taxes? They probably have to sell it or do something with it. So at the end of the day, you're thinking about, okay, I need to come up with cash. How do I come up with? Now, answer is simple. I understand. Dentists are treated very, very favorably with most banks to begin with. You can get a debt for 100% for the purchase of that. You may get 25-year amortization period too on that. So you've got the best of everything. Here is something extra that I can show to you, which can help on the insurance side. You don't necessarily have to do it or would want to use it for that, but you do have an option. So remember, I was talking about all that stuff earlier on. How many people I have to convince to kind of talk to you about insurance? Uh, Please talk to your tax accountant first, because you don't want to buy a hard asset like a building inside a your operating company, and then at the end of the day, if that building has multiple tenants in it and now it produces rental income, so now we have passive income coming, you may have challenges to purify that at a later point of time. Please speak with your tax accountant. It is really important to have the right structure to keep your important stuff in place. So how do we do with our whole life policy and the corporation? So assume that this is a associate dental practice. Uh, it owns the insurance contract inside it. We have the lender, we have the building, the lender owns it, the landlord, not the lender, I apologize. The landlord owns the building and is leasing it to your corporation, and you're thinking of buying it. So how do we go about? So first thing is that we collaterally assign this policy to a special bank, okay? Not your regular bank. There are lending institutes that do this job. When we collaterally assign, there are multiple ways in which the assignment can be done and leveraged. So there is one which is the easiest of them all, which is called cash value lending. So cash value lending is basically, you have a policy, you go, they assign the policy collateral. They want to see your income. They do a credit check on you. They just see your business financial. That is it. They don't ask a question on what you use the money for. The asset is a collateral to them. End of conversation for them. They release the cash to your corporation. Your corporation can then buy it from the landlord. Now the asset belongs to the corporation. The landlord is happy. You're happy. It's inside your corporation. It does add an element of value to your practice as well, because I went through this presentation earlier on. Was sitting and listening to Steve talk about it. Okay, potential buyers want to see a 5-year lease and a 5-year increments or a 10 years. Well, guess what? You own the damn building. It is your building. So the new purchaser is negotiating that with you. So go ahead and negotiate what terms you guys want to negotiate. The next scenario is how do we leverage the cash value for business purposes? Now, we are running a business. Every business goes through cycles. There will be some tough times that will come. It's not that, it's always going to be nice and things are going to be fine. It does happen with every business. I'm not saying that we have to use an insurance policy and go about everybody buys an insurance contract just because we can use it. No, absolutely not. There have to be right reasons for it. But if you already have it, not that you have to buy it, if you already have it and you're going through that challenge right now and you're wondering, okay, I need some cash for my business. Okay, times are tough. Now, why do I say times are tough? Well, here is the S&P TSX Composite Index performance from 1978. I'd love to say that's before I was born. It would be accurate too. Steve is laughing. I know that for a fact, but whatever, that is true. Okay. As you can see, these red lines indicate the number of times we've had major corrections. Now, why am I trying to bring this major correction? Well, look, here's what the problem is. If you were in this time zone over here, 2008, 2009, and the value of your dollar was a dollar because the market is either at the average or at the peak, and then it has dropped, now your invested dollar is worth 60 cents on a dollar. But guess what? If your invested dollar is gone from a dollar to 60 cents, your expenses do not go down from dollar to 60 cents. The expense is a full dollar. So if you're paying an expense from 60 cent, you probably have to pay an equivalent of dollar 60, dollar 70 for a dollar, just because the value has come down that much. Markets have corrected. There may be times where it may be prudent for that short-term duration to leverage what you have. When the markets come back, well, guess what? You haven't paid $1.60 for a dollar expense. You probably paid $1.07 for that dollar cent of expense. Now, again, leveraging is not for everybody. It is for some who understand the mechanics of it. So I would strongly advise that you speak with your relationship manager. This is not a question for your tax professional. This is your financial advisor question. So you probably may want to speak with them, whether it makes sense for you. But how does a client go about doing it? There are two separate scenarios over here. Depends on where the expenses and what you need it for. So if the policy is again inside corporation, it's collaterally assigned, the bank has paid money to your dental professional corporation. Okay, the money has come here. You got the money. Now, whether you're using the money for the corporation's need and there are expenses, you paid expenses over here, or there was an income need and you needed income personally, then that money could be used to give benefit to you. Either case, you are able to utilize the money. Yes, there is a tax consequence on the personal side when you're pulling the money out, maybe as dividend, maybe as a salary, but in times when there is nothing available, this is an option which is available. I'm not saying this is an ideal approach to go about doing your business, but I am suggesting one of the reasons why I wanted to talk about this presentation and this slide, and if I could quickly go back to the slide, what are the key advantages is that collateral uh, against a policy is actually a line of credit. It is not a term duration loan. So you don't have a 25-year loan, 35-year loan. It is totally open. You can have it just like you have a line of credit. It costs an upfront payment to have this in place, but it doesn't cost to keep it with you. It doesn't have a interest payable if there is no outstanding balance whatsoever. There is no duration. It can be serviced as interest only. So if cash flow is tight, we want to scale back on the expense, we can only service the interest. Can the interest be deductible? It depends on what that leverage is being used for. So in this scenario, when we were talking about they're buying this building is a capital asset. It is required for the business to be conducted. Yes, it is deductible expense. But am I a tax specialist? Absolutely not. Steve is. You probably want to talk to him. So there are a lot of benefits. Again, depending on the product, you can get between 50% CSV to loan ratio to up to 90% ratio. The policies typically have to be about 5 years old. They typically need to have between 250,000 plus to be leveraged. So those are your options as far as leveraging is concerned. So I've spoken about leveraging. I've spoken about a bunch of things. I think I'm coming pretty much to the end of the presentation. And here are some general planning ideas that you want to keep in mind. And when do we suggest about these policies? So first and foremost, when we talk about a participating whole life for our clients, we want to ensure that they are at a stage of either at the end of the growth or they are in the growth section. We do not talk about whole life when a client is just starting out, because there are million expenses that they go at the same time. We do not talk about survival period either, because you just bought a practice. You're already servicing a debt. You're paying down a debt. You have other debts on the personal side. That may not be the right time for it. What may be the right time is when you're coming closer to paying off your corporate debt and you've realized for yourself where you're going forward as far as your practice are concerned. Because everybody's priority is different. I mean, we have dentists who have 8 dental practices plus multiple other real estate investments. And then we have dentists who have just one dental practice, but it's a massive, massive practice. So everybody is different, and you may be on either end of the spectrum or somewhere in between. It is that much more important to first understand where you are. Ideally, you got to be in your established zone and your established practice, versus when you're starting out, it's just not going to make sense. You probably have some retained earnings. Now, again, depending on the structure, where those retained earnings are, how good the cash flow is, that may give a good indicative that, okay, maybe this is a good time for it. So again, free cash flow is important. There has to be some kind of need of state preservation. This is paramount. If there is no need of state preservation altogether, then we are looking at, okay, what alternate options are we trying to achieve over here and why we are doing. But generally, we would say that, okay, there has to be a need of state preservation. Like there has to be some financial loss in the event you pass away. If you're looking at putting a whole life in a corporation, ideally that corporation has to be owned by a single family unit. And why I say single family unit is that you don't need strangers inside your affairs. You've passed away, death benefit has come to the corporation. You had put money on a whole life side and you wanted that for your estate. So that is when we're talking about whole life. When it is term insurance and we're doing a buy sell, it doesn't matter. That policy was purchased precisely for that purpose. Okay, insurance planning principles. This is something that we follow on our end. We are generally need based. So we don't come to you and talk to you about insurance when you don't need insurance. That is not going to happen on in where we work. Okay, but we would generally tell you is that please try to buy products which offer some kind of flexibility. Life is uncertain, things happen. When you're looking at products and you're buying something, make sure that you have an option that you can scale up and scale down. You are at an option that you can lower the payments, increase the payment. You have the option of paying it up quickly or paying it for longer duration and reducing. It does really help because life is uncertain. There are times where you would be in a situation that you're not able to work, whether they're living benefits which are built into it, and those are exceptionally important when we have one client in the family who's a dentist and the other member in the family is not a dentist. It becomes exceptionally challenging. You can imagine when you make such big commitment that I'm going to pay 50,000, 100,000 each year, it is reliant on your income, your ability to continue. If you're not able to continue, there could be challenges. One size generally doesn't fit all. The word guarantee is paramount. I can't stress the word guarantee. Unless you read the word guarantee in the contract, it does not exist. I cannot tell you how many times I've seen this where clients have a perception, this is how it's supposed to be, this is what we are told. And I open the contract and the contract doesn't say any guarantee. It does become difficult. So just be mindful of that. Products can be structured differently. So a 10-pay product can be spoken of as 10-pay, but it doesn't mean that it is a contractual 10-pay. So there are planning options in which under insurance that we try to pay the policy in 10 years. We overfund it, but doesn't mean that contractually it is for 10 years. The payment period could be for 20 years, but it's important to know what you have. Any projections that you get generally have assumptions. At the minimum, I make an assumption that you are standard health and you're non-smoker, but I have no idea of what your health is. When we project our numbers, when we are looking at rates, we're like, okay, well, probably a standard health individual. I'm not saying your preferred rate or your optimum health rate, but I'm just saying that your standard health rate. So they generally have some kind of assumptions in there. Seek protections for what you do and not for others. Now, there would be times that you will find out that you have a business owner friend who's done something really fancy. Hey, I've done an IFA, and this is the next best thing on earth. I understand in certain cases, IFA type of strategies, I mean, where you are constantly in need of capital because you're going from buying one property to the other property, or one business to the other business to the other business, or one practice to the other practice to the other practice. There may be a crunch of capital. It may make sense. I'm yet to see a dentist who has that kind. I've met few, I've not met that many, but I just have a gut feeling that there may not be that many. And protect your family's interests, please. I cannot stress on this enough. I say this because I meet dentists come the get insurance. The first thing is the bank told me $1 million, I'm buying $1 million. And I'm like, you're just buying a practice. You have nothing else. Who are you trying to protect over here? The bank is happy. They're laughing. You pass away, the bank is paid, and your wife is crying because she has nothing. So please protect your family first. The bank will always get paid. Okay, with that Q&A. Sorry, I took too long. My apology. Where are we on this?
No, you did great. You were right on time.
Oh,
And,
am
and you
I?
did it all without breaking a sweat.
Okay, thank you.
Well, we do have a question.
Okay,
And it relates to the layering of way people save. And so the question is, would this type of insurance be beneficial to a non-incorporated dentist after one has maxed out TFSA and RSP?
okay. So I think there is a benefit for a non-incorporated individual as well, if and only if you have exhausted every other source. So first is you've invested in yourself and you are doing good in what you're doing. Number two is that you've worked with our tax planning guys. They kind of have looked at your numbers and they're like, you probably need to incorporate because on the number side it makes sense. But for whatever reason you haven't, then you've maxed out your RSPs, you've maxed out your TFSAs, all the other investment options that you thought of, you've done with them. Then life insurance absolutely comes to play. Yes, it does make sense. You do get that creditor protection and you do bypass probate. So those two important factors are eligible, available to you. And if you're unincorporated, I believe there is some kind of liability that is still chasing you because you're not incorporated. So that may be able to help.
Sanjeev, you've talked about a lot of the key benefits and features of the insurance. For those that are interested, there's the underwriting process, right? You've got to go through and do the
Yes.
medical. What
Yes.
about situations though where maybe one spouse isn't so healthy, there's concerns they might not qualify? What would happen in case where they want to have that estate planning tool in place for their family, their children? What would you say if one of them might not be insurable?
I think that's a fantastic question. At the end of the day, we really see this, and it does happen often because all those planning needs on the estate planning side typically happen at a later stage at life. And at later stage of life, we generally have some of the other health concerns that may come up. So for that reason, when we work on a joint last to die, which is typically the choice of plan, because those estate planning needs and taxes come on the second death. So for those situations, there are organizations and there are insurance companies for that matter who do have substandard rating program where one is kind of on the health side, not the healthiest, but the other spouse is healthy. So typically, if and I apologize, I don't mean to sound sexist over here. I'm just using the term the insurance companies use. So if the male client is not the best of health and the female client is healthy, then we have an option of getting a standard joint last to die. So please don't shy away from it. It does happen. Even with rating, sometimes with a participating whole life as an example, the impact of rating is actually very small. And we get surprised, okay, how is that possible? But in the numbers and illustrations that we do and see, the impact of 200% rating may only change premiums by maybe about 20% at max. That's it.
Well, it appears that is all of the questions that we have. We have a moment if there's any last questions that want to come in. But while we're waiting for that, Sanjeev, I just want to say I think you're going to keep tax accountants everywhere very busy
Oh, okay. Well, hey,
looking at insurance.
um, uh, just to be absolutely honest with you, I mean, uh, with my duration that I've spent with TMFD, working with you guys for over a decade, and with what I did at Asante, I've almost always worked with accountants and lawyers, investment planners, wealth planners. That is just my job. That has been so. The answers typically were like, okay, this part you have to speak to your accountant. This one you have to speak to your lawyer.
Well, it's definitely one of the key relationships that all dentists have, that's for sure.
It does, and I'm so
Yeah.
proud that we have that over here. I'm so happy.
All right. Well, look, it appears as though that's all the questions for tonight. So thank you, Sanjeev, very much. I think you provided great insight into the
you
variety of ways that life insurance policies can be used to enhance one's personal financial plan.
Well, I'm glad about that, and at the same time, I just want to let the viewers know that we do have a free insurance review that is available to the viewers. So, in case you would want to have a analysis of your existing insurance done, please feel free to reach out to me. My email address is listed right here. It's Sanjeev, SANJIV at tmfd.ca, or you can call me directly on my office number. That's 905-277-7915. So we do offer an insurance review for our clients. It's no obligation. It's not for the purpose that I want to sell you insurance and buy more insurance from us, but it's just done because you are valued clients or valued prospects who come to visit us on our TMFD site or visit webinars. So we are happy to help and give you a review about insurance.
Very good.
On top of it, I just want to let everybody know that we have a really special webinar that is coming up, which talks about multidisciplinary case presentation by Dr. Maria Lin. And I really, really look forward to this presentation because I really want to learn and understand myself how a multidisciplinary dentistry does practice. So happy that it's coming up. If you've not registered, please visit our website. This webinar is on Thursday. I think Jake has already talked about the webinar. It's on the 27th. So that is the webinar. And with that, thank you so much for your time.
That's fantastic, Sanjeev. Thank you so much. First, I want to remind our viewers that PACE credits will be issued within the next couple of weeks. And as we close, I'd like to thank you, Sanjeev, again for your valuable expertise and insight, and to Jake for running the show behind the scenes. And thank you to our guests for joining us this evening. We hope you enjoyed it and you found it very valuable. Thanks again, and have a great night.
Bye.
Take care, everyone.